Today's U.S. employment report is shaping up as one of the most important macro releases ahead of next week's Fed meeting, with markets looking for confirmation the U.S. economy remains resilient despite higher energy prices, ongoing Middle East tensions, and lingering uncertainty around trade and investment. Consensus expects payrolls growth of around 85K in May, down from 115K previously, while the unemployment rate is expected to hold steady at 4.3%. The broader narrative remains one of a labor market that is neither booming nor deteriorating, characterized by cautious hiring but historically low layoffs. The key for markets is that expectations are already relatively subdued. As a result, a modestly soft payrolls print in the 70K to 100K range is unlikely to materially alter the outlook for Fed policy or trigger a sustained dollar sell-off. In fact, downside risks may already be largely priced. From a market perspective, a bigger reaction function is likely to come from the tails. A stronger than expected report, particularly one north of 120K jobs alongside stable employment and firm wage growth, would reinforce the U.S. exceptionalism story. That outcome would likely support Treasury yields, underpin the dollar, and potentially pressure rate-sensitive sectors of the equity market, although broader equity indices could ultimately welcome evidence that growth remains intact. Conversely, a materially weaker print, particularly if accompanied by a rise in unemployment to 4.4% or higher, would revive concerns that labor market momentum is fading. That would likely weigh on the dollar, pull yields lower, and support expectations for eventual Fed easing, while creating a more mixed reaction across equities as lower rates compete with concerns over slowing growth. The broader macro backdrop remains important. The dollar has been supported by geopolitical uncertainty and higher oil prices linked to Middle East tensions, while equity markets continue to trade near record highs. Against that backdrop, today's payrolls report may not just be a test of the labor market, it could be a test of whether investors remain willing to price a resilient U.S. economy in an increasingly uncertain world. That's all for now.